to buy an apartment with a self-directed IRA. Hey everyone, Bergman here, tax attorney and founder, IRA Financial. And today's AdBits, how you can use your IRA or rollover 401k funds to invest in an apartment or even an apartment building. So this is a really, I think, fun and informative podcast. A lot of people don't even know that you can use your IRA to invest in alternative assets. And I always tell the story how I came to find the self-directed IRA industry. As you know, I am a tax lawyer. I have a master's in tax law. I've worked at some of the largest law firms in the world for almost 9 years. And it took me 8 years as a tax lawyer to find the self-directed IRA world. And I found it by fluke. I had a client that wanted to use his IRA to invest in his hedge fund. And I was lucky enough to be tasked with the assignment to assist him. And through doing research, I uncovered the holy grail of investing for retirement accounts and was blown away that someone can use their retirement money to invest in alternative assets like a hedge fund, like real estate, like gold, like private equity, like private stock, and changed my life. So this podcast is going to explain the rules behind using an IRA to buy an apartment or an apartment building. So the first rule to understand is what you can't do with an IRA. And there's 3 things you can't do with an IRA. That's it. You can't buy life insurance, can't buy collectibles like art. And then under section 4975, there's a broad category of prohibited transactions. And those type of transactions generally involve a retirement account and a disqualified person. And a disqualified person is defined as the IRA owner, their lineal descendants, their parents, their children, their spouse, daughter-in-law, son-in-law, or any entities controlled 50% or more by such persons. Okay, so you can't buy a house and live in it. You can't buy an apartment for your son. You can't buy an apartment from your parents. You just can't transact with a disqualified person using your retirement account. So that's what you can't do. But there's so much, as I previously mentioned, that you can do. The second thing to understand is once you understand what you can't do is now how do you structure your self-directed IRA investment, right? You've come to the conclusion that you want to buy an apartment or an apartment building with your retirement accounts. You know you can do it, right? You're not going to buy it from a disqualified person. You're not going to rent it to a disqualified person. So now you know you can do it. How do you structure the transaction? So there's really 2 ways to structure a transaction. You can use a self-directed IRA full service, meaning you would open an account with a self-directed IRA custodian like IRA Financial. You would do a tax-free rollover of your IRA or former employer 401k funds, tax-free to IRA Financial. And then you would have IRA Financial invest those funds and send those funds to the seller of the real estate. And then the title to the apartment or the apartment building would be in the name of the IRA. So, for example, IRA Financial Trust Company for the benefit of the Adam Bergman IRA. And that would be the title owner of the apartment. So when you get the rental income or you sell the apartment, all of the income and gains would flow back to the retirement account without tax, right? That is the primary benefit of using a self-directed IRA. It's a tax benefit. You do not pay tax, no capital gains tax, no ordinary income tax when you generate and receive rental income or capital gains from the sale of the real estate. So obviously that is the really exciting aspect of using a self-directed IRA or even any IRA to make an investment. So that's the first structure, right? The self-directed IRA, full service, really popular. However, for apartments and more complex transactions involving multitude of investment actions like paying rent or hiring a contractor to fix a window or any investment that there's going to be some action required, which is more active than just owning stocks or owning a bond or owning gold or owning crypto. A lot of folks like using an LLC, a limited liability company that's owned by the IRA. And that's known as checkbook control. And with the IRA LLC checkbook control structure, the IRA is still the investor. It invests in the LLC. The LLC is if the IRA owns 100% of the LLC, the LLC is treated as a disregarded entity for tax purposes. So it's basically treated as a tax nothing, but there's still some limited liability protection. And then once the LLC makes the investment, you would manage it as the manager. So IRA Financial would draft the operating agreement to show the IRA as the owner, have you as the manager, giving you what's called the checkbook control. And then here's the exciting part. The title of the real estate would be not in the name of the IRA, but in the name of the LLC, giving you anonymity, privacy. But you also get what's called checkbook control or wire control, because you, not the custodian, you can write a check or do a Venmo or Zelle to pay your contractor, right? To pay the painter, to pay anything related to the expenses derived from that asset. Whereas if you did the full service self-directed IRA, you would generally have to go through the custodian, IRA Financial, to pay Joe the plumber. So you get a little bit more control, you get more flexibility, more freedom. You get limited liability protection, which is super paramount and key. What's limited liability protection? Well, it protects all your assets outside of the LLC. So if you have other IRA assets outside of the LLC, they would generally be protected from creditor attack. Whereas if you had a full service IRA, if there is a creditor attack, they would generally be able to get all the assets within that IRA. So for real estate investment, especially buying apartments, multifamily apartment buildings, fix and flips, the LLC is generally the more popular option for structuring your self-directed IRA. Okay, so now we know all the prohibited transaction rules. We know how to structure investment. Hopefully you've done your diligence, right? You understand the economics, the financial terms of this deal. Hopefully it makes sense. You like the rate of return. You like your rate on cash invested. Now, what about leverage? Okay, so with real estate, a lot of folks like to use leverage or a loan to buy the real estate. So there are some peculiar and particular, I should say, more than peculiar, but it is peculiar, items to understand when you use a loan to buy real estate in a retirement account. Number one, the loan must be a non-recourse loan, meaning you cannot personally guarantee the loan. That's the peculiar part. Okay. The reason is 4975C does not allow an IRA owner to personally guarantee an obligation of their IRA. And then if you get a non-recourse loan, you're generally going to have to put at least 35 to 40% down and probably pay a higher spread, a higher interest rate, because the lender is taking a higher degree of risk because the asset is non-recourse, meaning you're not personally guaranteeing it. Now, the last aspect to understand if you use a non-recourse loan is this four-letter word tax known as UBIT, unrelated business income tax. And the UBIT tax is triggered if there's more than $1,000 of net income attributable to the acquisition indebtedness, to the loan. So here's a simple example to understand the reach of UBIT and its implications. You put in 50 grand in your IRA and you borrow non-recourse $50,000 from a bank or a friend, just not from a disqualified person. So that's 50-50 percentage debt to equity ratio. If you, okay, generate, for example purposes, $10,000 from that asset, okay, net after depreciation, after expenses like paying the mortgage off, and let's say, example purposes, in a perfect world, you're left with $10,000. Because 50% is debt or acquisition indebtedness, 50% of the $10,000 would be subject to this UBIT tax, okay? And that could travel as high as 37% at a very low income threshold, about $15,000. So it's a painful tax. Now, there is an exemption if you do not use an IRA, but use a 401k. If the 401k would have bought the apartment, there would be no UBIT, which is very, very, very interesting and very advantageous. And that's why a lot of real estate investors try to get into the solo. How are you eligible for a solo K? You just got to be self-employed. You can't have a business with any full-time employees other than the owners, their spouses or the owners. So there are avenues to get in to a solo K and then circumvent the UBIT tax, which can save you 37% tax. You can also minimize it by using a corporation to reduce the 37% to 21%. That's called a C Corp blocker. Okay. But remember, a lot of these real estate deals do not generate a lot of income in the first couple of years, right? There's a lot of expenses, there's improvements, depreciation. So if there's not more than $1,000 in net profits, there's no UBIT. And the good news is you can carry forward the losses to offset any future income. So this is important to understand. That's why I'm highlighting it for you. And another reason why you want to work with a company like IRA Financial that can not only set up your self-directed IRA. There's a lot of companies out there that can set up your self-directed IRA to buy an apartment. The exciting part of a company like IRA Financial is we will help you structure your investment. We'll make you understand and highlight and spot potential tax hiccups and hurdles and moguls that you got to overcome. And then we're going to help you navigate them and hopefully eliminate any hidden taxes or at least minimize them. So we go above and beyond, and we have the expertise and the pedigree to do that, which no one really else has that in the industry. So we literally wrote the book on the self-directed IRA. I've written 9 books. We have over 25,000 accounts, 3.6 or so billion in assets. So we are the trusted one for doing self-directed IRA, especially for real estate investors, especially if you're going to do some complexity and want to make sure you understand all the rules. And I think with our flat fees, you get a lot of value for choosing IRA Financial. And that is probably maybe a selfish plug, but it's the truth. And I feel strongly about that because I've seen some horror stories, trust me, where investors bought real estate and they didn't know UBIT applied, they didn't understand the prohibited transaction rules, and now it's a very, very, very difficult process to unwind it. And I definitely do not want any of you to have to go through that. So whether you work with IRA Financial or some other company, just make sure you ask the questions before, talk to someone, explain what you want to do, make sure you're comfortable and confident that they have the expertise to handle your investment and make sure that they can protect you from any potential IRS tax implications. So that's it for today's podcast. Hope you enjoyed it. Hope everything is going great. And you found it informative. That's the whole point of these podcasts, is to teach, learn from each other. A lot of these topics I get from you. I talk to people and say, hey, can you do an AdBits or an ad mail or an Adam Talks on these topics? And I'm like, absolutely. I'm always looking for good topics. I love doing this stuff, but if it's not helping you, what's the point? So that's it. Have a great day. Thanks for hanging out with me today. And I hope to see everyone again next week. Ciao and take care.